This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Right, let's have a look at an example that pulls together everything to do with your vertical group structures. And you can always tell without even reading the requirement that you have a vertical group structure within your question, because what you've got is it gives us this draft financial statement. So statement of financial position at December 2015 of three companies, Bravo, Gale and Russell. And what you can see there is that Bravo has an investment in Gale. Okay. And then what you can see there is that Gale has an investment in Russell. So as soon as you see an investment in two separate companies, so in two separate companies' books, automatically you start to think that there will be some complex group structures. Okay. So going from the left to the right is probably parent, sub, but we'll read that as and when we get there. So let's read the requirements, see what we've got. Said it wants the consolidated statement of financial position for the Bravo group. So Bravo is the parent, as anticipated at December 2015. Okay. And again, what I would recommend that you do, similar style to a complex group structure question without any individual accounting standards being examined. The first bit of the additional information gives you information about the group structure and what happens at acquisition, anything to do with fair value adjustments, etc. Okay. So what you've got there is it says on the 1st of January 2015, Bravo purchased 80% of Gale. Okay. And then in the next paragraph, it says on the 1st of July, so halfway through the year, Gale purchased 70% of Russell. So what you've got there is, I think it's worthwhile, isn't it, drawing up your workings and actually starting off with working number one, the group structure. Okay, so what you've got there, was it Bravo? I think it was Gale. Was it then Russell? And what you've got, 1st of January, Bravo purchased 80% of Gale. So that means that Bravo is the parent, Gale is the sub. That took place on the 1st of Jan 2015. And that must mean that there is a 20% non-controlling interest. Okay. Everybody happy with that? Nice and simple. On the 1st of July, Gale purchased 70% of Russell. So again, the parent has control of the sub. The sub has control of Russell. So Russell is now a subsidiary. And that took place on the 1st of July 2015. Okay, so part way through the year. Key bit was we spoke about the importance of the acquisition dates when we did the very first introduction to the chapter. The key bit there is that the parent and the sub became part of the group on the 1st of Jan. The sub didn't become part of the group until a much later date, the 1st of July 2015. Okay. However, do just be aware, if the sub becomes part of the group at a date earlier than when the parent purchased the sub. Okay, so let's just say that Gale acquired Russell on, shall we say, the 1st of July 2014. Then Russell doesn't become part of the Bravo group until Gale is actually acquired, is it, on the 1st of Jan? So that earlier acquisition date of the subsidiary, i.e., did we say the 1st of July 2014, is ignored. The acquisition date of the sub, the acquisition date of the sub are the same if the sub was acquired at an earlier date. So just bear that in mind in case the examiner wanted to throw in anything that was a little bit complex. But aside from that, what we've got there is your effective controlling interest. We multiply down the spine. 80% of 70 is that 56. and then to work out your effective NCI, that's just the difference, isn't it? Is that 44%? Okay, so I do really think it's important that you set things up with regards to the workings when you start to get complex groups. Okay. Once we've done that, we can then read the information. It's pretty much the same as normal. So you're told how much we paid. Was it 74 million that Bravo purchased Gale for? The fair value of the net assets was 90. And the non-controlling interest was 25. And the fair value of the net asset at acquisition wasn't materially different to the book value, so no fair value adjustments. I'm being too generous. In the real exam, there will be fair value adjustments, similar to what we saw in the earlier chapters. If we look at Gale, again, that purchase Russell, 70%. Was it there for 55 million? Retained earnings were there. Was it at 20 million? The non-controlling interest at acquisition is 20. And again, the fair value of the net assets was not different to their book value. Okay. And the group policy is to value non-controlling interest based upon the fair value method. Okay, so no surprise given that we were given the fair value of the NCI anyway. So what I would then start to do is I would start to play around with the net asset. So working number 2. And have a look, first of all, is it at Gale? Okay. So we're looking there, is it at the reporting date? Is it there at the acquisition date? And then everything within that post-acquisition period, isn't it? Again, I think we've kept it simple. I think we're just looking at, is it share capital, retained earnings? There we go. So share capital, retained earnings, 50 and 75,000. So you've got the 50,000. 70,000 being share capital, retained earnings. Share capital doesn't change, so that is always going to be 50,000. We need to find the retained earnings at the date of acquisition. Ooh. Have a look at that information in that first paragraph there. Can you find the retained earnings? Have a read. Can you check? See? Doesn't tell me what the retained earnings are, does it? Not at all. All it does is it tells me the fair value of the net assets was 90 and that the book value wasn't different to the fair value. So they are the same book value and fair value. So given that we know that the fair value of the net assets is 90, if the share capital was 50, then we can work out the retained earnings as a balancing figure must be 40,000, mustn't it? Okay, it's just a balancing figure. If there was a fair value adjustment, we wouldn't be able to do that because we would have 2 figures that were missing. We would have to have been given the retained earnings. If we total up the reporting date net assets, that's 120,000. So it gives me a movement post acquisition is that of 30,000. Okay. We then need to do exactly the same working. Is it there for Russell? So when I'm going through, I'm thinking about Russell. Again, 40 and 45 share capital, retained earnings. So here, share capital, retained earnings. Was it 40,000 and 45,000 at the reporting date? We then need to look at what it was at acquisition. Well, again, the share capital of 40 stays exactly the same. So that is there as 40. The retained earnings, just a bit different really. We're actually given the retained earnings. So here you can see that the retained earnings are 20 million. Okay. So you've got retained earnings there. Is it of 20 million? So that gives me 60. And is it 85? which then gives me my post-acquisition movement. Is it of 25? Okay. Just check share capital reserves. Yeah, I've got them the right way round. Okay. Excellent. Once you've got that, we're into the world of goodwill. So working number 3, goodwill. Remember, the layout is the same. It's just ever so slightly adjusted, isn't it? So what you've got there on the left of your 3 columns is the goodwill in Gale. Leave the middle column blank. And then on the 3rd column, you have Russell, don't we? Again, we've got the is it in the middle. We can put the narrative. You've got the fair value of consideration, the fair value of the non-controlling interest, which you add, and then you will deduct working number 2 at acquisition. Okay. What I'd do is I'd work the sub first. Just stick to what you know best. If you can do that, you're going to do quite well. So here we paid, was it 74 million? And the NCI was there as 25. So 74 and 25 million. The net assets from working 2, what have we got? The net assets from working 2 at acquisition are there as 90. So the 90 goes in there. There's no impairments. Let's not complicate it. Let's save that for revision and the exam. Does that go through there and give me 9,000? Okay. When we go through and look at Russell, which is the sub-sub, that's where you need to be ever so slightly careful, don't we? Because what you've got is that we know that the investment in the sub-sub is there as 55 million, isn't it? But what we need to do is we need to take P's share of that 55 million. Because we're reporting to the shareholders of the parent, and the parent owns 80% of the sub, and the sub has an investment of 55,000, so they own 80% of the 55. In that second bit of information, we're told that the NCI was valued at 20 million, just at the bottom. So we can add 20 million fair value NCI. The net asset to acquisition of the subsidiary are there as 60. So I will go through there and deduct the 60,000. 44 and 20 is that 64 less 60 gives me 4,000. So my total goodwill is there as 13,000. And I hope what you can appreciate from doing that is that the only difficulty is that bit there, isn't it? Okay. Other than that, everything else is exactly the same as what you've seen before. So don't panic. Okay. If we then go through and look at, is it working number 4? Working number 4, remember, is the non-controlling interest. Again, we've got our columns. Is it there for Gale as the sub? So Gale, the non-controlling interest was there, was it as 20%? Remember, we said it's important to put in the percentages. And then you then have on the right-hand side, is it Russell? And Russell, the effective NCI is 44%. So 44% in there. Again, keep it simple. We've got there the non-controlling interest at acquisition, which is there as working number 3. And then what we need to do there is we need to add on the non-controlling interest share, don't we, of the post-acquisition figures from working 2. Okay. Forget about the crazy, very hard adjustment. Don't think about anything to do with that. Let's keep it simple. So the non-controlling interest at acquisition was there, wasn't it, as 25. and 20,000. So nice and straightforward. So there, 25 and 20,000. The non-controlling interest share, the post-acquisition. Well, one, you need to take 20%, and for the other, we need to take 44%. We just need to get the right figures, don't we? So let's think about Gale first. If you scroll back to Gale's net assets, you will see Gale's post-acquisition movement of net assets is there as 30, isn't it? So 20% of 30 is that 6,000. And then for Russell, well, we've got the Russell's net assets. Post-acquisition movement is there as 25. So we've got the 44% of 25,000 is that there as 11,000. That's easy, isn't it? Nothing difficult. You get a mark for each, or 4 marks within the exam. Okay, yeah, not so bad, is it? The difficulty then is that what you need to do is you need to deduct, isn't it, the non-controlling interest share of S's investment in the sub-sub. Okay, so S's investment in the sub-sub is that 55 million, isn't it? Okay, so we need to deduct the correct percentage, so 20% of the 55,000. You know, we've already adjusted for 80%, haven't we, in the Goodwill calculation? Here we're just adjusting for the other 20%, because when we're calculating the non-controlling interest in the sub, we want to calculate it in the sub only. Okay, we want nothing to do with the sub-sub, so we need to remove it. Okay, again, just so you can remember, VH, very hard. Okay, you might get the right number, brilliant, well done, but you forget to deduct it. I see that's happening so many times. It's really frustrating from a student's perspective. If you total it up, I think you go through there and get, is it 20,000 for Gale, and is that there, is it as 31,000. Again, if we go through there and total it up, I think your total is 51,000, isn't it? Okay, there we go. So again, amongst all the madness, the only bit that is entirely mad and crazy is that adjustment there. Okay, nothing else to it. Other than that, everything else is just the same. If we begin to finish off the workings, we've got working number 5, your group retained earnings. So we start off there, is it with 100% of P, to which we then need to add on 20% of S, and was it 56% of SS? Okay, so what we have there, 100% of P retained earnings is 65. And then the post-acquisition profits, remember, always come from, is it working 2? So for the sub, it was the 30. So 20% of 30,000. Does that give me 6,000? Not 20%. Careful, Christopher. I'm sure you're all shouting that at me. It's 80%, isn't it? 80% of 30,000. Yeah, that's more like it. Is that 24,000? And 56% of, is it 25,000 of Russell? Okay, so 56% of our 25,000. Does that give me 14,000? Adding that up, 65 plus 24 plus 14, does that give me 100? and 3,000. Okay, so we've done all the workings. That's where the majority of the marks come from. Now we can go through there, can't we, and finish things off and look at the group statement of financial position. Okay, so what we've got there, same as always, property, plant and equipment. We need to look at 100% of P and 100% of S and 100% of SS, don't we? So 90, 53 and 70. So 90 plus 53 plus 70. There's no fair value adjustments in this question. I've taken pity on you to make sure that you understand the fundamentals. So for working in thousands, that's $213,000. We then have, is it the goodwill? Goodwill comes from working number 3. The goodwill we totaled up, was it there, of 13,000. So that goodwill figure appears in the SFP there. And then we have your current assets, don't we? Again, sped it up a bit in this chapter without separating it out, inventory, receivables and bank. So 40, 48, 33, 40 plus 48 plus 33 gives me the 121,000. 121 plus 13 plus 213 gives me 347,000 as my total assets. Does that then equal the equity plus the liabilities? Let's hope so. So we've got the, is it your share capital? Remember, share capital, even in a complex group structure, is still looking at 100% of the parent only, which is there as 100,000. So we've got the, is it 100,000? Share capital. Retained earnings are there as working 5. I think it was 213. Correct me if I'm wrong. No, wrong number. 103. I think I'm getting it confused with the PPE number. There we go. 103,000. The non-controlling interests, NCI is there as working number 4, isn't it? So NCI was there in total when we totaled it up at 51,000 from working 4. We've then got, is it non-current liabilities from the question, 20, 15 and 4. 20 and 15 is 35 and 4 is, yep, that's it, 39. Thank you very much. And the current liabilities, what do we have? 19, 16 and 14. 19 plus 16 plus 14. 16 and 14, that's nice and easy. That's 30 plus 19. 49, isn't it? So that gives you 49,000. Totaling that up, 100 plus 103 plus 51 plus 39 plus 49 gives me, there is that 342,000 compared to 347,000. We've gone through there and made an ever so slight mistake, haven't we? 213 plus 13 plus 121 gives me 347. 100 plus 103 plus 51 plus 39 plus 49 gives me 342. So where's the mistake that we've made with the 5 million from somewhere? Okay, let's have a look. 20, 15 and 4, 40, 48. Let's just check the numbers as we add across. So 20, 15 and 4, 19, 16 and 14, Yep, so that's all right. I'll go into the workings in a moment. PPE 90 plus 53 plus 70 is 213. Are they the right numbers? 90, 53 and 70. 40 plus 48 plus 33 gives me 121. So again, those are right there. Let's just have a quick check, shall we, in the calculations on the Goodwill. First Goodwill, 74 plus 25 less 90 gives me 9. 80% of 55 gives me 44 plus 20 less 60 gives me 4, so that's 13. So that looks right there, doesn't it? Using the 55. Excellent. I don't think there's anything that we've done untowards there, is there? Okay. If we go through there and look at the NCI, 25 and 20. Excellent. 20% is it of 30? Again, yeah, that's right at 6. 44% of 25 is 11, so 31. 20, so that's 51,000. It all seems pretty right. Okay. 30 and 25 are the post-acquisition profits. Yeah, 80 times 30 is 240. Is 14 plus 24,000 plus 103,000. Yeah, 65. Maybe that it didn't originally balance, but other than that, we've done everything correct. So I wouldn't particularly worry about it for now. Eureka! I found it. I've seen where I made the mistake. You probably spotted it already and were shouting down the camera at me. I put in the retained earnings at the reporting date of the subsidiary Gale as 70, when really what it should have been was 75. Okay, so if you put in that 75 as opposed to 70, that will give you 5,000 worth of additional post-acquisition profits, and then those post-acquisition profits feed into working 4, working 5 respectively. And what that would then do is it would go through there and change the retained earnings. It would change the non-controlling interest. So I think you should get, is it an extra bit in retained earnings? The extra bit that you should have, I suppose, would it be 80% more of the 5,000? And then you will have 20% of that extra 5,000 going in. So what you then get is 80% of 5,000 is 4. So does that ultimately turn round and end up, is it as 107? And an extra 1,000, which makes that, is it 52? And when you do 107 plus 52 plus the 100 at the top plus 39 plus 49 gives you the 347. Okay. But like we said, that's great. It's balanced. 347 there. And is it 347 on the assets? Now, it's one small mistake that I made. It would lose me 1 mark, but provided that the examiner and the marker could see that that mistake was continuously used throughout the rest of the question, then I wouldn't lose any more credit. Okay, so even though things didn't balance, they didn't balance due to one transferal, if you like, of a number from the question to my answer. It's not worth stressing about within the exam. So it's a really good demonstration, just purely by chance, to say, look, it wasn't right. It was slightly different than what we expected. Leave it, move on. Because if you correct it, which we've just done here, it's going to take you ages to do to get you 1 mark. Okay. Other than that, that's it. I'll see you next when we start to look at your D-shaped complex groups in full.